So, hey everyone, this is Finance Meets Real Estate. As you guys know, we meet here every week, 6:30 p.m. Eastern Standard Time, usually. And so we have amazing guests every single week. I was just talking to George, we've had over 100 guests at this point in commercial multifamily, triple net lease, single family residential investing, and like different investing fields. We've had a few lenders also on the call, and George has a great firm in the field that I really like. And so so today we're going to talk about, I think, a topic that's like pretty important right now, like financing your investment property in a volatile market. It's a very challenging interest rate environment, so it's extremely timely to have George here today. So George is the co-founder of Morphin Lending. So he's gonna talk about like investment property. So primarily 1 to 4 unit, perhaps some commercial, but more like residential 1 to 4 unit properties. So he serves as counsel and leads business development and marketing for Morphin Lending. And prior to partnering with his co-founder, he was an attorney practicing in New York City, and he now establishes company relationships with borrowers and works to grow and expand the company's reach in new markets. So George graduated from St. John's University School of Law with JD. And so with that, I'm going to pass it on to George, and let's have a conversation today. I think everybody's pretty curious as to how to execute deals. Myself as well, it's very challenging. Cash flow is kind of squeezed out. It seems to be more of equity plays, and which makes it riskier to execute. So I'm not sure what your thoughts are on that, and like what are some strategies that we investors, in the residential commercial space should pursue?
Bitcoin, probably. So no, thank you for having me. I appreciate it. It's great to be here and talk about this, especially right now. Like you said, it's something that we haven't really experienced. I mean, there's been cycles that we've seen, we've read about, we've heard about, but coming out of a pandemic and dealing with everything that we've been dealing with, it's hard to gauge like where we're at and where we're heading, just because like this is unprecedented, obviously. Mm-hmm. So definitely today kind of try to focus on some things that you can control in kind of like this market that's constantly shifting. But yeah, like you said, Stefan, we mostly do 1 to 4 unit residential. We lend pretty much across the U.S. I would say we have our strongest markets are in the Southeast, and then like Texas, Northeast. But we see a bit of everything from everywhere. And yeah, I mean, where to begin? So like, obviously rates in our space for rental loans, for 30-year term loans or 15-year, as of now, they're like 9+, pretty much. Mm-hmm. So, to kind of
asset-based. So asset-based permanent loans, they've got them quite aligned with bridge financing, right? They seem to be pretty much at par, it looks like. Is that the case, or as far as asset-based?
Yeah, bridge is going up as well. I mean, bridge, I think we're entering the 11 to 12 space pretty much across the market right now. But yeah, so I mean, I think like the biggest thing, right? The hottest phrase, the strategy that most people were employing was the Burr method that Bigger Pockets coined, and everybody knows that. And I think the Burr method in particular is probably the one that's most at risk as going away, because it's very hard to cash flow at these rates, especially if you're looking at single family homes, where when rates were in the 3 to 5% range, your DSCR was at like, I don't know, a 1.5, and you can make that work. Now that those properties don't really even cash flow anymore, now that rates have doubled. So I think that's one major thing, is like if your main strategy was a Burr, it might be time to kind of like reevaluate that. And perhaps start shifting and pivoting a bit more towards flipping.
Right, but George, if I can hold you like on that part, so okay, so actually you answered my question. So kind of like basically a sale would be the more likely exit than a refinance on a kind of an equity gain strategy, residential, commercial, or either way, right? Just if you have too high interest rates, you've already raised the value of the property, you have a higher value and a higher and pretty high rates, it's kind of high to refi.
Yeah, exactly. And rates are, like I said, they're in the 9 to 10 range. Excuse me. A few years ago, we were in like the 7 to 9 range on the DSCR product. And where we saw the most activity was with investors that were looking at 2 to 4 unit properties, because then that covered, right? Your gross rent was covering the monthly loan payment. And I think that's kind of like another part of, doing a BRRRR or being a buy and hold investor. Single families are great because they're much more liquid than other property types, right? Like you can sell a single family to another investor. You can sell it to someone who's going to own or occupy. You can sell it to someone it's going to be their second residence. 2 to 4 units, price point's a little bit higher, more maintenance, requires more of you. So single families always are seen as a little bit more attractive from that standpoint. Easier entry, a lower barrier to entry for a single family versus a 2 to 4 unit. But unfortunately, like now, like we're saying, with rates being where they're at and prices not really correcting quite yet, I think a shift to looking at smaller multifamilies is probably in your best interest for the time being. And perhaps the foreseeable future, because I don't know when rates come back to better levels. But yeah, so that's definitely one major thing to consider if you're a buy and hold type investor, is looking at multi units versus like kind of like moving away from the single family space, unless you're trying to flip it. But
so
yeah,
purely on the grounds of kind of having more cash flow there, or just on other
yeah, mostly, yeah. If your end goal is cash flow, like you're not going to see it from a single family unless we're talking about short-term rentals, and we can get into that. But yeah, so another thing is definitely, I think, easier said than done, but using less debt right now is important. Whatever type of deal you're getting into, whether you're taking on a rehab project, a flip, or you're buying a property that's stabilized from day one, I think you want to take on a little bit less debt than what you're used to, right? We used to do acquisitions on a long-term loan on a 30-year. We used to do them at 80% of purchase, right? That's dropped, and I think industry-wide that's dropped to 75 now. I could see that dropping further, because especially at the 75 LTV bucket, like that leverage percentage, you're getting hit with the highest rate now. So yes, you're putting less down. Obviously 70, you can put 30% down, you can put 25. Yeah, sure, you're saving 5%, but the rate adjustment at that LTV is pretty significant. So then, you really have to factor in your cost to finance now more than ever. And I think that's one thing when you're talking to a lender, is ask to see different options. See what their rate is on a 30-year fixed, see what the rate is on a 7/1 ARM, on a 15-year, and then at different LTVs. Ask, again, obviously using leverage is great, but I think now's the time to be a little bit more flexible and maybe put more into a deal than you normally would have, just so one, your cash flow is better, because you're carrying less debt, but also your rate's going to be lower. So that's definitely something to keep in mind.
Right. So you mentioned, like, during our kind of like earlier conversation before this webinar, like you mentioned, essentially kind of, let's say, starting a flip right now, and let's say you mentioned like the flip executing 6 to 9 months, like that is potentially being kind of a risky time frame, let's say. So why is that? Just purely from the perspective of interest rates and price volatility, or just interest rate volatility, or?
Well, it's a little bit of everything. There's just so much uncertainty. I think now is the time to try to get into projects where you can get in and out, 6 months or less. For one, right? when we talk about rental financing versus flip financing, we compare the two. Rental rates were at 3.5. We're talking about DSCR lenders, at more asset-based property cash flow type lenders like myself. We were lending at 3.5% on a 30-year fix just a year ago. Today, that same scenario might be at 10%. So,
and just to hold you there, like George, just for a second, excuse me, like just DSCR for some of our audience who don't know, DSCR asset based. If you want to kind of mention,
sure.
Like,
so we're considered an asset-based lender. I wouldn't say we're totally asset-based. And basically, when you say you're an asset-based lender, it's that when you underwrite the loan, when you're processing the loan, the primary focus is on the asset. So for our type of lending, if we're talking about a rental loan, a property that's rent ready at the time of closing, we primarily look at one, the property's value based on comps, and then two, the DSCR, which stands for debt service coverage ratio. And all that means is we want to see that the gross rent covers the monthly loan payment. But when we say monthly loan payment, we're looking at monthly principal, interest, taxes, and insurance. So you just take your gross rent divided by PITI, and you get your DSCR. A healthy DSCR or a decent DSCR is a 1.2, meaning your residual income is 20% of your gross rent. So a 1.2, that's what it signals, that after paying the loan each month, you're left with 20% of your gross rent. And that's what lenders like us view as a good DSCR, a good one, not like great, not a home run, just like what it should be. That's not to say we've done loans against properties that don't cash flow because it's more of like an equity play. Right now, as a lender, I wouldn't want to be doing a DSCR loan where it doesn't cash flow. But that's another conversation. But yes, that's what DSCR is, and that's what asset-based lending is. But just to quickly add, even though we're an asset-based lender, we still pull credit, we still do background, we still care if you have foreclosures, if your credit score is 620, if you miss payments on your primary, and it's important to note that right now in this type of environment, those things matter so much more. If this was a year ago and you came to me and you had a 640 credit score, I mean, I don't love it. I have to see why it's there, but chances are we'd still make that loan to you. Today, there's no chance of that loan happening. There's no way. So now more than ever, it's important to pay your bills on time. Try to pay down debt 2 to 3 weeks before you get your credit checked, because obviously a lower balance means a up in your score. And you just pay it as much down as you can, as much as you can down. You don't have to pay it off completely, but all these things help your score.
Right. But you guys, like in your position that you are in, you see the projects of so many flippers essentially, and also long-term buy and hold through your other long-term product, right? The DSCR product, as you call it. And so like, what have been some shifts that you're seeing with flippers? Has there been any adjustment in how they operate? Kind of still operate the same?
Yes. No, definitely. I think the more experienced investors that we work with have really kind of taken a different approach. And it's like, I'm not an investor, so I'm a lender. I just happen to deal with real estate investors every day, so I get to learn from them. And it's really what they're saying matches what I'm saying, that they're mostly focusing on deals where they can get in and out in like 2 to 4 months, 3 to 6 months maybe, but nothing beyond that. Because they're worried about the market shifting in their submarket, in their area where they're operating, where values maybe start coming down, homes stay listed longer, so their carrying cost goes up, and all these things are playing a role in that.
What is an example of that? Like 2 to 4 months, that's like really fast, right? Like on the other hand, the market is more liquid now. It's harder to sell. There are fewer transactions. So what is a feasible project that you see in the marketplace that perhaps somebody is executing right now in that?
It's tough. Yeah, everything's easier said than done, especially for me, when I'm the one not, trying to source the deal and, they're bringing it to me and I'm financing it. Everything's easier said than done. But yeah, mostly cosmetic stuff, right? Like and like this is more for an investor to come on and talk about, but it's all about your marketing as an investor, your sourcing of potential deals. Now more than ever, that's like super important, that you have a great process in place and you really identify what sort of deals you want to go after. But yes, mostly cosmetic,
Okay.
you're not like deals where you're avoiding adding units, expanding the properties, expanding the square footage, some more cosmetic, like updating, stuff like that. I mean, I even see investors now who are doing what's called like wholetailing, or, buying a property, not doing anything, but like maybe cleaning it out, cleaning it up, and then relisting it back up. And maybe instead of making 40,000 on that deal, they'll make 20. But you know what? Their cost is significantly lower, and they can move that quicker. So I've seen that as well being employed now.
Mhm.
So they'll take down the property, own it, get in there, clean it up, do minimal stuff, and then just relist it.
Mhm. And that helps with what? With, I guess, like having like shorter horizon and kind of like easy execution, just pure variables.
Yeah, everybody's just scared of the unknown, obviously, and that goes without saying. Like we just don't know where values are heading. So
right. So do you guys? So, and I know like interest rates is kind of like nobody can predict too well, right? But do you guys follow, like, what is your sources for like forward interest rate? Is it like Chatham Financial or is it something else? I'm just curious.
who's that?
I
No.
don't know.
So
That's what I use. Like I'm looking at their forward curves for
well,
that.
so this is also part of like financing in a volatile market. Like you should know who your lender is, where their money is coming from, where they're, who are their capital partners and all that. I mean, so the way rates are set pretty much, I'm not from the capital markets side. I was an attorney, as you said. So, but my partner, my co-founder, Tyler, he worked as a mortgage-backed securities trader. So he was, buying loans and securitizing. So he's the guy to have on this podcast to talk about securitizations and the capital markets. But they set the rates.
Like interest rate scenarios for the future or something. I don't know. Like, do you guys speculate on that?
Well, no, we don't. Look, we constantly talk to the institutions that we sell to. So we sell to a bunch of different loan buyers, and we were constantly talking to them. Most of the conversation and most of the dialogue is more so about credit enhancement and what can we do, what can they do to make sure that we're mitigating risk, or they're mitigating risk as much as possible. So lowering leverage, lowering LTVs, in certain markets, increasing credit score requirements, increasing DSCR requirements. These are things that they're more so focused, because rates are rates. The Fed's going to move again, and then we're going to move again, and that's pretty much how it goes. So yeah, the conversations are more so around like, how can we make sure that we're underwriting properly and accounting for the additional risk that's existent now in this sort of market and environment. So yeah, I don't know where rates are going to go. Probably like our type of loans, the DSCR loans, probably like 10 to 12% on the 30-year is probably where we'll be in the next 12 months. Yes, I think for sure, 10 to 12%, unfortunately, but hey, it is what it is. We have to figure it out. But yeah, that's, I think that's extremely important, right? So when you're working with a lender, right, you should know the most important aspect of financing right now is the rate, because like it's so tight that even 25 basis points can bring you down to a DSCR below a 1. So you want to be working with a lender that rate locks, right? And that you're aware of their rate lock process. And that's where we've seen most of, we're going green here at Mofin. Sorry, my lights went out. But yeah, you have to be partnered with a lender that rate locks. Okay, I can just.
No, it's not.
Sorry. Okay, sorry about that. Yes, sorry, but yes, no. But rate locking is very important. So you want to make sure that you're with a lender that locks when they say they will. And that's where a lot of real estate investors have gotten hurt these last 6 months is they'll get a term sheet from a lender and the rate's great. They're like, oh my God, you're like a point below MOFIN. And they're like, yeah, let's get it going. And then you're like, let's do it. 3 weeks later, you get the appraisal back, everything's good. You're like, okay, when can we close? And they're like, in a week, but hey, just, the Fed moved. So just to let you know, like,
Right.
that 7.5 is now 8.75. And then you're like, what the heck? I thought you locked. You sent me a term sheet. And it's like, oh no, we don't lock until the appraisal's back. And it's like, where does it say that in your term? And that's happened. The number of conversations I've had where people are like, oh my God, they bait and switched me. So like that's huge right now. It's like really grilling whoever you're working with on their rate lock practice. Like we rate lock once we send terms.
What's like, that's a question I'm wondering myself. Like, what's an optimal loan to leverage? Then you're saying, considering like it's good to reduce leverage. What's an optimal? Just whichever one keeps you within 1.2 DSCR, or is it more than that?
I would probably say more than that. Again, as an investor, you have a different, like we're dealing in this on the same deal, but your perspective is different, right? Like for me, at 1 DSCR makes it work. And then I can, we sell that loan to an institutional loan buyer and they're happy, 1.2 DSCR. But for you, your residual income is 20% of the gross rent, like after paying the loan only. That doesn't take into consideration third-party expenses like a property manager, ongoing maintenance, all these things. So you really have to analyze like, okay, I'm left with 20% of my gross rent after paying this loan. What are my other costs? What are the other costs associated with this property? What could go wrong? What do I have to plan for? So no, I wouldn't say 1.2. If I was an investor getting into a deal, I would probably want to be at like at least a 1.5. Right. Like a 1.4, 1.5, I would say. But yeah.
Right. But at the current rates, that's probably like a 50% leverage or something, right?
Well, exactly. Yes, it is. Unfortunately, like even, like at 65%, I'm seeing 1.2s now. So at these rates, unfortunately, that's where it is until prices correct a little bit, right? So it's either until rates come down or until home values come down. And I don't think rates are coming down. So, and I don't think rental rates are going up anymore. We're like in historic highs in most cities. So yeah, I think, yes, until price is correct, it means putting down a lot more.
But it's just, for me, like one of the like super simple, like puzzling thing is, I don't know, it's just like the weird thing for me is that executing the same deal that we did last year, that has the same equity upside, let's say, but there was cash flowing then and now it doesn't cash flow at all. And so now it's like just purely becomes, that's it. I'm just saying, like for me, in my own like private investing, let's say it becomes like a equity play type of thing where you don't have. And so now I don't know what metric should I look at to consider it safe in terms of, if I have sort of the revenue paying of the mortgage, but what if the revenue slips in a recession and things like that? There's this. So
that's what and I also tell that to a lot of investors. I say that to a lot of investors. It's like, are the rates artificially high? Are the rents artificially high right now? Is that a product of everything that's been going on in post-pandemic that, you're getting 1,800 for a single family, where in a year, is that going to drop to 1,500, 1,600, 1,400, so like that also comes into play. And that's why I like flips more than, rentals right now, especially, lighter flips. Again, easier said than done, but yeah, that's why there's just so many variables with rental properties right now that it's tough. It's a lot tougher.
Right. Yeah, we've started seeing, I don't know if it's going to be so much here in the Northeast, but we started seeing some of the rent drops in the markets where they kind of grew excessively, right? And they kind of started.
Yeah.
So yeah, that might be a bit of a noise kind of rent growth that happened. Because I know like many operators, they were, we're not projecting 10% plus rent growth. We're only projecting 3%, but guess what? Maybe it's -3.
Yeah. Yeah.
It's a totally different story, right? So it's not like, but and so that's like an interesting question always. So what do you think about, are you guys, let's say lenders, are you concerned about prices dropping, or you're like pretty indifferent yourself? I mean, on your end, you sort of make a spread, you sell the loan to institutional, and
Well,
like what's
we
your
don't like.
exposure, so to say? What is your exposure into
We
the
have
market?
some. Yeah. There's obviously some risk there when there's reputational risk and our track record. We're a small team. We're a smaller lender in the space. We rely heavily on our reputation and our track record. So even though we can sell a loan, and maybe we have no risk after a couple months, that we still feel like that's our loan for the life of it. We stay on, when a borrower closes a loan with us, even if we were to sell it. Some loans we hold, but some we sell. Even if we were to sell it, you still work directly with us. So we don't really see it as like offloading risk, even though we are essentially offloading risk. But yes, values dropping. Obviously, there's going to be a surge in defaults. It's just what's going to happen. But that's why you focus now on your underwriting right now as much as possible, because this will expose any flaws or errors or mishaps in your underwriting processes. So yeah.
But let's say, because you mentioned you can't work over the countries, are you guys offloading risk more in certain regions than others? Or
yeah, of course.
Or you don't have this kind of betting or sort of prejudice or perspective?
Look, just like I'm saying, like I'm advising flippers or investors to get in and out quickly. It's the same that we're doing, right? It's like we're originating a loan. If we think we're going to sell it, we're doing what we have to do to sell it ASAP. Right. So yeah, I don't care if the loan's in New York City. I don't care if it's in Baltimore. I don't care if it's in Savannah, and we like it. Doesn't matter. We're just, making sure that we're being super efficient right now and just moving quick, because I think that's the name of the game for everybody. Is like, what today looks like. You don't know what tomorrow looks like. So if you get it done today, do it. So yeah.
But so to say, I guess what I'm trying to get to is like, if let's say you originate a loan in, what should I say this time? I don't, Nevada. And let's say Nevada prices are very exposed, relatively speaking, more exposed to downside risk than New York State, or not New York, let's say New Jersey, And so, which I think it's a fair statement. Like, is that a choice you guys make, or you're pretty indifferent whether you originate in New Jersey versus Utah, Nevada, and some of those more overheated?
Well, for one, we do not lend in Utah, Nevada, Arizona.
Okay, fine. Well, I guess let's use Florida, the Southeast, because I know you mentioned you do a lot of Florida, right? So let's say, do you pick Florida versus Northeast, or it's kind of, we're pretty indifferent for now? Just curious.
Well, it's a tough question to answer, because there's so many different factors that we look at. I mean, when we originate a loan, we want to make sure if it's institutional loan buyers. So first and foremost, we look at that, right? So we see, what are they saying about certain areas, certain MSAs? Like, do they have leverage reductions? Do they have enhanced experience requirements? And then we then internalize that and say, okay, well, if we own this loan, is it a riskier project to take on? Given that, we have an aggregator that's buying 150 million of loans a month, and they're saying like, hey, if you're doing a loan in Chicago, -5, -10% on max leverage, experience has to be +5 of what it normally is. So yes, so we definitely look at that, and it's like, okay, well, someone bigger than us is saying that. Let's be a little bit wise here, a little bit more more conservative, and that's a loan we're going to be like, what, they're still willing to buy it. It's obviously a little bit riskier. We'll originate it at the levels they want to see it at, and then we'll probably offload that and sell it. Yeah.
One sec. I just got a message, like Vlad, like we have somebody on the chat. So actually, I think I'm gonna see you tomorrow. And by the way, I don't know if George, you would be joining us tomorrow in New York. We're doing an in-person event.
Yeah, maybe I will. I saw it in like the Lower East Side, or is it?
Yeah, kind of around East Village or something.
Soho. Yeah. Okay. Cool. Yeah, I'll be there.
Yeah,
I'll
if
pass
if
by.
you have the time would be cool. Yeah, and
Yeah.
so because I think Vlad, do you have a question actually before you take off, or just making sure? Maybe no. Okay, it's fine. Good. So okay, interesting. So I know you guys, because you mentioned that you get basically you get a lot of feedback and input from the institutional buyers of your loans, and that's that's a very high quality feedback supposedly. But let's say, are you seeing, when you mentioned Chicago has sort of reduction in like, or enhanced experience requirements maybe for the borrower and so forth, with raising points or lower LTV and so forth, is that, what is the distribution of that? Are you seeing those? I know you guys don't do rural, for instance, is one thing, right? Rural is always a big no-no for, so what is the main driver of rural? Just revenue risk, or just the liquidity and kind of harder to sell?
For rural, yeah, it's more of the latter. Like just not as liquid as of a market. Not many comps. They
Not
stay,
just not comps. Okay.
no comps. It stays, listed longer, tougher to sell. So, you as a lender, you always look at the worst case scenario, which is like a default and foreclosure. And, you don't want to own a property in a rural market, because you take that over where you try to sell it. I mean, it's going to be
Correct.
tough to recoup and recover. Yeah. So
Right.
we avoid rural markets and yeah.
But so to say, would you say that, because rural, I guess it's understandable, it's not so good for a lender, right? Because you want to offload the loan relatively quickly at the exit, right? In that scenario, and be able to do that. But would you say it's equally, perhaps like equally not so good for investors, or perhaps for an investor that could be an option? It's just more like, because they can offload themselves, but you guys cannot do it at scale.
So that's a good question. It can still be a good investment from an investor standpoint, but once you start factoring like, hey, can I get financing against this property? And the answer is no. Like, is that a good investment anymore? I don't know. If you've got a ton of capital at your disposal and you want to be, it's all you in that, all cash, God bless you, then do it. That could still be a great deal, but you have to realize that you might have that money tied up into that property until you sell it. So we were doing some rural properties when the market was good, like in more vacation areas, like in the Poconos, for example, which is rural, but I think even now that's going to be difficult. So yeah, it's definitely important, because I get that all the time. In like Tennessee, there's some rural areas that
I've shown you some rural kind of like deals myself.
It's tough. It's tough. Like, they might be good from your standpoint as an investor, but it's just tough. Like, the secondary market does not like rural properties.
Right. No, that makes a lot of sense. I mean, it needs liquidity and so forth, and comps and etc. So, okay, one question that we got actually. So Constantine is asking, so how do you sustain business? So I guess I'm not sure. I was asking like what he means by sustain, in a sense. And do you guys get investors, or like how do you like, I'm not sure, in the lending space, you have to come up with the initial capital and then launch it and so forth, and you just kind of save up, raise from friends and family, I guess, right?
Sure. Yeah. I mean, we started this back in like 2015, very, very part-time in 2015. And then I think we made our first loan in 2016. And it took, like you said, we started out with very little capital. We made one or two loans. The toughest part was finding a counterparty to sell those loans to, because $75,000 loan to an institutional investor is basically, you could tell them like it's a $5 loan. So it was very hard to get that first trade done. Thankfully, like I mentioned, Tyler worked as a RMBS trader, so he had some contacts within the market, and we were able to get something going. And then from there, we just raised friends and family money separately, and we manage that. Tyler does most of the that, but we do that as well. So we have our own capital that we manage. We have a decent sized portfolio of loans and assets that we manage, and that's how we've grown to date. Slow and steady. But yeah, sustaining business is tough right now. But
how did you guys decide to go in the lending industry, and like sort of how did you even learn it, so to say, like how to do it, like how to find institutional buyers for your loans and so forth.
Yeah, it's not easy. It's not easy. Not everybody can do it. Even if you put your mind to it, you can't do it. Sorry, but no. So basically, a big piece of it was like the fact that like Tyler, my partner, co-founder, worked in that space as a loan buyer. So that made it a lot easier. And then our head of underwriting, James, who's another principal of the company, he was in CMBS for quite some time on the commercial side. So between those two guys, we had a very good idea of like the capital markets aspect of the business. And then I was an attorney, so I was able to help with like the formation and of the entity, of the company, and everything else that went with that early on, kind of like the IP, like intellectual property stuff, like trademarks, getting privacy policies going, helping with like that stuff, and just like the closing documents, all the disclosures, all that stuff. And then it kind of like evolved into me just learning the business through Tyler, and just really reading and studying as much as I could. And now, I think, I know I'll mention this to Tyler, but I think I know underwriting guidelines as good or better than anybody. Just from pure,
I know.
Yeah, just from pure effort.
We've spoken, we've spoken on loans. Like I've called you a few times, and like I've noticed, like you guys are very savvy always. It's a pleasure to talk to you, right? Like
I appreciate that.
I mean, this is one advantage of I would say, especially Morphin as a lender, but even kind of like your industry, right? Like it's way better connecting to investors and understanding their needs and kind of like working with that, right? It's a whole different product basically almost.
Yeah, and I would say like I said, Tyler, who's my partner, he handles every closing that we do. And the pre-close and closing and post-close, that's all Tyler. Then James is the head of underwriting. So he oversees the underwriting of every single loan. And, James was very senior in the CMBS space for like, I don't know how many years he worked in that space, 15 years. Tyler is 10, 12 years, I think. Both extremely intelligent individuals, extremely intelligent, so much more competent than the roles that they're in, so much more experienced. And so, this is definitely an advantage that we have over other lenders, because like when you call us, we've taken our business model and flipped it from the typical hard money lender, where when you call another hard money lender, it's an account executive, right? Who has maybe a script or is looking at like a sheet that tells them what they can and can't do. And then you never talk to anybody with real decision authority, whatever. With us, you call us, it's typically me, unfortunately, that answers. And I'm the one evaluating your deal. And then James, who is our head of underwriting, is the one like reviewing your deal. And then Tyler, who's my co-founder, is the one who's closing your deal. And our support team stays behind the scenes. So yeah, so it's very different than, our competitors. Not the same experience working with us versus them.
Okay, see. So Letitia has a question from the chat. So do you guys cover the Midwest, like Chicagoland area and in Illinois?
Yeah, we do. It's tough. Yeah. Chicagoland area, Cook County is tough. It's just historically speaking, like a tougher market to operate in. But we definitely, we're doing a couple loans there right now, actually. So yeah, some solid opportunities there.
Right.
Yeah.
So where do you see like some of your strategy adjusting now in the future, or is it just more like reducing loan to value? Or like how are you shifting your business basically in the current environment?
It's tough, right? Because like you have a lot of lenders, competitors out there that are still chasing. You have like lenders and borrowers chasing the lowest rate and the highest LTV and the most leverage. But those are the guys who are most susceptible to shifts in the marketplace, right? When rates move, it hurts because they have to move, and then they retrade or reprice the borrower. So we try to price appropriately, right, in terms of rate and fees, so that way, let's say we're not locked somehow, but even though we lock the moment you sign a term sheet and you're like, hey, I want to work with you guys, we're
Mhm.
locked. If we're somehow, for some reason, not locked, I mean, we try to price it with like, with moves in mind, with rate moves in mind. So that way we don't have to come back to you and say like, hey, your rate is going up or whatever, or same thing with leverage. We're not trying to max out on LTV on every single deal in case there's a shift in the market and no one's buying loans at, whatever 80 LTV anymore. And all of a sudden they're like, and it could happen this quickly. And it's not just MOFIN, these are loan buyers that some of them buy from like 50 to 60 lenders or, more. So if they move, if the higher ups move, that doesn't just affect MOFIN, that affects, our industry. It's there's widespread implications. So if a loan buyer says, sorry, tomorrow we're implementing this leverage reduction for this type of deal, and you're at that point, then you're going to have to move on your borrower, and then that hurts your reputation, that hurts them. It's just so we're trying to be a little bit more conservative. So dropping LTV slightly and making sure we're pricing appropriately on rate and everything like that.
Right. I see. And in terms of like you guys, because I know you guys do have a commercial product, but then you mentioned you work more in the 1 to 4, right, space. Now, do you see that on expanding or?
No, not right now. I think
No,
now
okay.
is a tough time to expand into the commercial space.
Isn't that supposed to be like where like more cash flow comes and it's a little bit safer in some way, or it's just not your original area of expertise to kind of be?
Yeah, definitely not my expertise. I think especially here in like the tri-state, you have so many banks here that are willing to lend at much more competitive terms than what we can provide, because we would be selling to the same kind of loan buyer, and that same loan buyer typically only focuses on 1 to 4 units as well, because they securitize. So like doing mixed use or doing multifamily, the pricing is not going to be as competitive with us, frankly. On the bridge side, maybe we do it, but there's a lack of liquidity in that market as well right now. There's a major lack of liquidity. So
I'm asking you, so like one of your competitors, not to be mentioning names, like seem to be branching more into that.
You can mention them.
Like I think Lima one or more.
Oh, I saw Lima one doing more multifamily. Yeah.
Yeah. So why do you think that is? I was just thinking again. I'm not acquainted with any. I thought that's a trend, but apparently it's not.
I forgot who Lima one is. I forgot who they're backed by, who they got bought by. But it could just be a product of that. They just have some capital that that they want to deploy into that space, and it's probably a finite amount. It's not like it's not going to be a core part of their business, but I'm sure it's they just have some capital to deploy there. But yeah, no, we started having excuse me, we haven't seen any sort of demand from our loan buyers, and it's not like we talk to a bunch. I mean, we're constantly talking to different loan buyers just to make sure we're market and we have our finger on the pulse. And it's not something that we've heard there's an appetite for.
Yeah, I mean, you guys like flipping, right? I guess that's like you're in
right.
the rental ones, and you did too, but kind of like in the current environment, sounds like flipping is a good route. And
well, yeah, one thing to like note, right? Like I was saying earlier, rates for 30-year went from like 3.5 to like 5, from like 3.5 to 5. That it was quite some time in that range, to then it jumped to 9 to 10, right? For fix and flips, it went from being at like 10, like 8 to 10 to 10 to 12 now. So the cost of financing in the hard money space, like the pure hard money space, hasn't really increased that significantly. It hasn't gone up that much. It's about 2 to 3% annualized. So it's gone up, but the shift hasn't been as extreme.
yes.
So there's still opportunities there to make money, and it's not hurting that type of investor as much as it is the buy and hold type investor.
Yeah, that makes a lot of sense. And okay. And do you guys, because you mentioned you guys work in, let's say, Arizona? I know Scott, my friend, is here.
Sorry, Scott. No, Arizona. It's one of the few states we do not lend in. It's like Arizona, Nevada, Minnesota, Utah, Vermont. We don't lend there. California, if anybody is in California, we lend in California. We lend in New York. In a Hawaii, if you want to you bring us to Hawaii, I'll lend there.
Interesting. And do you guys have any questions actually? Because if somebody else has questions other than, because I've been asking myself quite a few.
Hey, sure. Yeah, I've got, I guess, two questions. So the first one, I don't know, it doesn't sound like this is necessarily a product that you would have on your books, George, but my limited understanding of like where the damage could come from loans going bad is the borrowers who got into loans over the past 5 years that at the 5-year mark either hit maturity and balloon or they need to be readjusted at a higher interest rate. And so my question is just like, with you being so in tune with this, is there a ton of those types of loans out there that are going to be hitting that mark in the coming, say, year or so that could cause a lot of turmoil?
There were, but I think those low rates actually helped us with that pool of loans, because most of those people, when rates hit 3.5, refied. They didn't care if they had a prepayment penalty, because they went from being like 7, right, or like 6.5 on an ARM or on a balloon, to now having access to a 30-year fix at 3.5 to 4% on an asset-based underwrite or a DSCR underwrite. So I think a lot of people, I mean, we were refinancing, people were coming back to us to refi loans that we did, 30-year loans that we did for them like a year prior, or a year and a half prior, and they were in like year 2 of their 5-year prepayment penalty term. So they would have to pay like 4 points to like pay that loan off early, and they were still doing it because they were like, I'm at 7.5 and you're doing this at 3 3.75. Like, yeah, I'll pay the 4 points because I'm never gonna touch this property again. So I don't think there's, from what I've seen, I don't think there's a major concern, because I think a lot of people jumped on the wave and refied when rates were so low. So hopefully I'm not mistaken, but if I am, then you're right. Then there's going to be a lot of pain that comes from like a loan that adjusts, right, in the fixed interest rate period ends, and yeah, there's going to be a lot of defaults there for sure.
Yeah, it's scary. That's good to know. So my second question, you mentioned earlier that you are not an investor, and so I'm wondering, like, with all your experience with underwriting and you having such like a deep understanding of how to look at a deal, why aren't you buying deals yourself right now?
Well, I started MoFin with my partner, right pretty much right out of law school. That was first and foremost. And starting a company, you don't make a lot of money, frankly, to be candid, in the beginning. It's very difficult. And then when you do, you want to reinvest in yourself and in your company, I think. And I also like staying in my lane. I really, I think being a jack of all trades is great, but being someone who focuses on one thing and specializes in one thing and really knows that, I think there's a much more of a demand for that type of individual. And it's funny because I just read a big article in Bigger Pockets. It was obviously sponsored. It was from one of our competitors who was saying, like, now more than ever, like, invest with a lender that's also an investor. And I was just like, I think that's BS, because I know someone who didn't go with me and went with the competitor because they're an investor. And then that competitor ended up kind of like bait and switching them on the financing terms. And they came back to me, and I wish I could just post all like these emails that I have with these people, because it sounds like made up, but like, no, it's not. And it's just like, yeah, so I like to stay in my lane. That's number one. But definitely, I think now more than ever, opportunities are going to start popping up. So, I'm definitely open to any sort of opportunities to get in the game now, because I think the next like 6 to 12 months, we're going to start seeing some great opportunities if you have, the capital to deploy. But yeah.
Cool.
Right.
Can I ask questions?
Yeah. Go ahead, Eric.
Oh, there's Eric.
Can I ask you a question?
Yeah, go for it. This is Eric Lancher. This is a full disclosure. I employ his wife.
That's a good disclosure.
Yeah, and we went to law school together. What's going on, Eric?
So you talked about, and I might have missed the beginning of this, but you talked about starting MoFin in 2015, and I'm wondering, and you mentioned kind of like an early example of a loan that you guys went to market and sold. I'm wondering, can you describe how, one, the geographic area has changed over the years, and also the types of loans? Like, when you guys started out, I assume that example you gave was not hyperbole, that really is like something you did. And then can you describe how the loans changed in terms of location for the projects and so on?
Yeah, I mean, like so much has changed in the last 7 years. Um, so I think we're mostly in the same markets that we were, and we've grown with the changes and we've adapted to the changes. So like it's not like we've exited any particular market because we've seen certain things happen, or prices go a certain way, or rents go a certain way. Like we're still in the same markets. Like for example, like we started out doing a lot. We our first few loans were in Savannah, and yeah, we've just seen home prices and values go up there, but we've just continued to do business there, and like our investors have changed either their approach or strategy or whatever to make it work in like a changing environment. So we haven't really left any markets or anything like that because of certain changes. We just figure out like how do we underwrite maybe differently in that market, or yeah. Yeah, that's a good question. There's other markets where like for example, there's state prepayment penalty restrictions in certain markets, and that affects the economics of the loan. So like Ohio, which you're familiar with, doesn't allow prepayment penalties on like, I think it's 1 to 2 unit properties. I may be mistaken, but in the beginning we had loan buyers that for whatever reason, didn't adhere to that. So we would be able to originate a loan with a prepayment penalty. They would buy it. They'd be okay with it. It wouldn't affect the terms of the loan. Then we started moving to other loan buyers, and they had that sort of prepayment penalty restriction. So that would really impact the rate we'd be able to give somebody, because if we can't put a prepayment penalty on a loan, there's an early refinance risk to that loan, right? So there's a higher likelihood that person could just pay off the loan, and then that's it. We got our money back. The return that we were expecting isn't there. So that has to get priced in from day one. So that really hurt our ability to originate loans.
This one, because may I hold you just on the early prepayment quickly, because that's a part I don't too well understand, because like sometimes in conventional.
You don't like prepayment penalties, Stefan. I know that.
I know
that.
No, I get that, but no, I'm just trying to understand the discrepancy like amongst lenders, because sometimes in conventional financing, what I've heard like before, when I used to get conventional financing, well, I still had a W-2, that is. So I would go to, I would get the loan, and the lenders would sometimes tell me, I was talking to one of the biggest volume lenders in New Jersey. I can probably know him. Not gonna mention names again. Okay, it's fine.
Don't mention him.
So it's his comment was, if you refi like after the 5th month or so, you're gonna verify. And I didn't know like what drives that, because they had like in conventional, it seemed like they're pretty indifferent if you refinance, like as long as you hold it several months or whatever.
Oh, that's more on the capital market side.
Not the case in anything. For you guys, as far as I know. So what is driving that discrepancy? Why conventional refinances are so lenient, but commercial and asset-based are prepayment penalties?
Well, it's all about like who's eventually owning the loan, right? Like the exit strategy, who eventually owns the loan. Really, that's really what it comes down to. Like when you have like loan buyers who securitize, and and you're selling to Wall Street, they want to know. I guess they want to know what they can make on that loan, and that's why you put a prepay. But like I said, I'm not a capital markets guy. I just know that.
What's the point? Like, what is the point that makes it profitable for them or you guys, or let's say for your institutional buyers of your loans? Like, is it like, does it have to be 5 years, or is it like 2-3 years?
No. Yeah, we can do a no prepay, but that definitely affects the economics of the loan significantly. You're going to have to probably pay to buy down to keep the rate at a lower level than where it should be, because if there's no prepay, now you're telling me you can just take our loan and then refi the next day. You're going to have to pay like points up front to get that. But excuse me, but you can do a 1 year, 2 year prepayment penalty. And in that term, prepayment penalty term, then the rate will go up a little bit, but there's no like points being paid at closing to make that happen. It's only with no prepay that's the case. But yeah, you can do a 1 to 4 year prepayment penalty if you wanted.
Right, but let's say if we assume prepayment, why do they go up to 5 years? That's a break even.
Oh,
Profitability of
probably
sort,
has to do with securitizations. Yeah, I don't know why 5 years in particular.
Okay.
Well, but actually, a plug for MoFin, we're now doing like, I don't know if it's a good thing or bad thing, but we can do up to 7 years. And that's definitely something like to talk about with your lenders. Like, what can we do to keep my rate down or my monthly payment down? Because those are two different things. Because like, you can keep your monthly payment down by doing a 10-year IO, like a 10-year interest only period.
Right.
But that's going to increase your rate slightly. But you can decrease your rate by doing a 5-year prepayment penalty and structuring the prepayment penalty fee as a fixed 5% for 5 years versus a declining structure of 5% to 1% in years 1 to 5. And you can get a lower rate for doing that 5% fix. So there's different things you can do to try to get the rate a little bit lower right now. And that's one of them, like doing a 7-1 ARM, doing a 5-year prepay with a 5% fixed fee.
Right.
Yeah, and we're doing 7-year prepays now too. If anybody wants to take it, I don't know if anybody wants to do that, but yeah.
Actually, I'm not sure if I interrupted Eric's question. there.
I was
Well,
just gonna ask a follow-up.
Yeah.
You know, one thing again with the history of the company, I'm just curious with the profile of borrowers. It has to have changed, right? From when you're basically trying to get whatever you can, right, in the beginning.
Whoa.
I mean, not whatever you can, but you know.
No, it's whatever you can.
You, yeah, I'm sure you were bending some of the underwriting, you know.
No, not bending the under. Yeah, no, you're just like when you begin. Yeah, so like that's why I think I'm still a 35-year-old single man, or am I 30? I'm 34. It's because I'm conditioned to question why. Why do you want to work with me? Because in the beginning, when you have no presence online, you have no track record with borrowers, you were getting people who were hearing no from like the top lenders in our space. Like Lending Home was saying no, and then like Lima One was saying no, then Lending One was saying no, and then it was like, who do I go to? And then they would find MoFin, and they'd be like, hey, and I'd be like, oh man, this sounds like a great deal, and then I would review it more, look at the guidelines, talk to our loan buyers, talk to my partner, and we'd be like, oh no, this is a horrible deal. So yeah, in the beginning it was tough, definitely, but now we got it to a point where we've kind of distinguished ourselves as a bit more of a competent and reliable lender. So now we get guys and gals who are doing volume, a good amount of volume each year, and super competent, going after some bigger deals, going after some more complex projects, and that's who we deal with. But we still deal with newer investors as well. We're just a little bit more careful and strict about that criteria for like who can we work with as a newer investor. But yeah, it's definitely changed a little bit from day one to now.
The one question, like I know we're kind of at our time, but I was curious, like also related to interest rates. So I follow like some of the business private equity guys, if you will, like Kyle Mullen or whatever, just basically people who like to buy businesses instead of buying real estate, but they're real assets businesses, and they're pretty heavy on depreciation benefits and so forth, right? And so in that sense, and one of the things I've noticed, and which is probably should come as no surprise, but that's like way stronger cash flow. I mean, not stronger because I guess it reflects risk, but just like way higher cash flows, than real estate. So where in real estate, you have your cap rates at like 5. Maybe you can get even up to 10% or whatever, but let's say 5 to 10%, and those are like 20 to 30% of the business value, like in real businesses. And is that potentially, and so it's like less sensitive to interest rates. So I've been curious, like an innovative asset-based lender like yourselves, is that something, or is just too much of a jump to jump into something outside of real estate, like other real assets essentially, or is that something you guys consider or some of your competitors consider?
It depends. Like I said, we try to stay in our lane and we try to do what we know.
Okay.
But for example, right now, like within our industry, there's opportunities, right? Like there's lenders who lend against mobile home parks, and mobile home parks, the cash flow there is pretty solid.
Yeah.
But the asset's difficult, but so lately what we've been doing a lot more ground up construction, and and like the secondary market has pretty much shut down on ground up construction. But we see, we like that asset and we like that type of loan. So, we've been doing a bit more ground up than we've ever done actually. So those are the sort of opportunities that we're looking at, is within our space, kind of like where can we branch out a little bit and find
always
other
real estate, right? Never, it's not going to be, let's say, an HVAC company or whatever, like very.
Hey, that'd be cool, but
businesses. No,
I'm always like marveling at people who actually have different businesses,
right?
And they're just someone who owns different companies, and they're able to. Unfortunately, that's not us. Maybe not yet.
Yeah.
We're still relatively young fellas, so maybe we'll get into that in the future. But right now, we're just trying to make sure that MoFin is operating the best it can, and then making sure we're stable there and growing there before we look at other opportunities. But we know real estate well. We know debt extremely well. So we're trying to just make sure we don't lose sight of that and focus there.
Okay, sounds cool. Okay, any last questions before we wrap up for today?
Eric, do you have another question?
I don't want to ask any more about the history of MoFin.
Why? I like the origin stories are all the rage nowadays.
They're very cool.
Yeah, they're very cool. But no.
So so George, we're probably gonna cut this from the webinar. We're gonna be tomorrow, Midtown actually, and sorry, not Midtown, East Village, like you mentioned. So we're doing a commercial and prop tech too, by the way. You guys are kind of prop tech almost, right? I mean, pretty much as well. You guys use a lot of technology and as well.
Yeah.
So so we're doing like that meetup. So it's with Amy Thiemann.
Oh, we got a question over here from,
sure.
from Devin Keller. This guy, he wants to be aggressive in the worst market. All right, let's address this. So you want to read it?
Yeah, sure. So Devon is asking, so during this down market, does MoFin see the next few months as a time to get aggressive and continue to grow, or be defensive and wait out the storm? Secondary market.
I know what Devin wants to hear. He wants to hear that MoFin is going to be aggressive. He wants reassurance that MoFin is going to be aggressive. Well, I'll tell you this, Devin. We are being aggressive while also being defensive.
Maybe from an investor perspective, or like Devon, do you mean from an investor perspective or from a lender perspective to be aggressive?
I'm assuming from a lender perspective in like our operations, and So no, definitely right now, like we see it as an opportunity to grow because so many lenders have exited the space. A lot of lenders who've remained have kind of, thank you. A lot of lenders who've remained have kind of lost a bit on process. So no, definitely, we see it as an opportunity to grow. Loan buyers have exited the space. Last week, one did, a couple months ago, another one did, so, and a lot of our competitors were tied to these loan buyers. So with the loan buyer going out, it just means there's a bigger pool of investors that are kind of like lost and in limbo, not knowing who to work with. So, we definitely see this as an opportunity to grow. We're not, we're being defensive or conservative in our underwriting approach, but we're being super aggressive in how we're operating. I mean, we've onboarded a couple of new people. We're spending more marketing than we ever have. We've never spent really any money marketing. This year we spent more. And we're talking to more loan buyers than we ever have. So no, we're being much more aggressive than I think we normally were in the past.
Right, but wouldn't, in a way, like, because you mentioned earlier you stayed competitive on the flipping kind of product in a way, and it's not so much changing the economics for flippers, perhaps even the current environment to some extent relative to the change that other segments in the market are seeing. And so, but that said, still, like, it's still supposed to be kind of a reduced activity of flipping even, like, or anything else, right? To an extent, is it something concerning you, or like how, like, what is the opportunity you guys pursue in that direction, or is it just
Yeah.
to slow down for everybody in the industry and so forth?
Well, I think it's an advantage right now to be a smaller company like we are, right? Our overhead
True.
isn't great.
That's true. Mhm.
You know, so
Yes, so you can capture potentially a
we
work
can cap
more market.
if we do 5 more loans than what we were doing last year at the same time. I mean, that's not that difficult to achieve because of like our team size and what we're, you know, what our cost is to operate. But it would, you know, it would be huge. So yeah, I think we're in a good position that we're a little bit smaller, and we've been very conservative with how we've been operating internally, so that we're healthy financially as a company. So yeah, no, I definitely think, you know, this is we're positioned well for this type of market, but it's definitely scary, right? It has slowed down. I'm not saying that it's all great. There has been a significant slowdown, but like Devin said, you know, second, like normalization is starting to take effect, with more so with real estate investors than it has in the capital market side, right? I think real estate investors have finally like turned and accepted defeatedly that they're in this new environment and the good times are over, and it's time to like really make sure you're operating in the appropriate manner, because everybody was making money the last like 3-5 years, right? Like it's been great. So that's, unfortunately, that's over. It took some time for people to realize that, but yeah, that's over, and now things are starting to pick back up. But let's see. I mean, you know, Fed moves again, and then market crashes again, and then yeah, we'll go from there.
Mhm. Yep. Well, so thanks, George, for being here today. So that was great. That was fun. And yeah, so we'll hopefully we'll see you at our in-person event, like I mentioned, tomorrow. And
Yes.
it was a lot of was a lot of good information. Always a pleasure to speak to, like, I think the lender side for me as well. I'm sure for our audience as well, to get like your guys' perspective and input. You guys get a lot of intelligence about like different investors doing projects. Like you see like the most investment projects out there, right? Pretty much. So that's extremely valuable. So yeah, so with that, like, what is the best way for people to reach to you?
Probably by email. It's my first name, George, at mofinloans.com, MOFINLOANS.com. They could also call me directly. It's 917-913-7349. Yeah, text message me, call me. Happy to talk.
Sounds good.
Does the 1% rule still apply to screen properties? A late question from Stella. I don't think so. But yeah, I don't think so. I don't think the 1% rule really applies anymore, but
that's true. Well, I mean, yeah, I guess it probably depends. You could find some markets, perhaps, like, so like maybe again in Chicago land. Yes.
One of our, so an investor I was actually at lunch with today that we work with, he's pivoted to markets like in like Toledo, Ohio, for example, where that still works. Yes, that still works. But I warned him, he's not watching this live. I warned him, like, you're gonna have a very tough time financing those properties. And he's, you know, and he was like, well, what if I pool 5 to 10 of them together? And we're like, if you pool a bunch of, you know, whatever together, it's still that same thing, just more of it. So, you know, that's what I said. So like, if you pull 5 of those together, 10 of those together, you're still gonna have a hard time financing it. And yeah, that's unfortunately the position he's in right now. It's kind of like he's finding it difficult to get permanent financing on an asset that, you know, he's buying for 75 to 90,000, but it cash flows well. Yeah. So the 1% rule applies there, but it's very hard to get debt against that sort of property.
Right. So George at Muffin Loans, right? Was that George at muffinloans.com? I have your email. Yep. Okay.
Yep.
Yeah, I mean, I think that's what's, for me, you're right about Toledo, and I think that's what sucks now, because some of those markets that carry operational risk, kind of like they're operationally risky markets. On the other hand, they're actually they carry less market risk now. So that's a kind of a conundrum, if you will. Like, what is the word? You know?
Yeah, well, where can you rent a one bedroom or I mean, where can you rent a single family home for $850 a month or $900 a month? Like, yeah, that's becoming rare. So those are solid markets to be invested in, but there's a lack of liquidity for that type of asset. So yeah, I mean, we used to see it. I still see it in Memphis. Like Memphis, Tennessee is another one where same kind of like price point and same rental income, and it's just tough. Like no one wants to originate that debt because no one wants to buy that debt. So it's riskier. Lower value properties are definitely riskier. Just from, if you think about it from the from the default standpoint, like if you have to take back a property that's worth 75,000 and you have a loan of 50,000 against it, your legal costs are gonna, and if values drop a little bit, and then you have legal costs, I mean that your debt, your liens could go away. I mean you take a loss on that sort of asset, on that sort of property. So yeah, it's just tough.
But what are, I guess, okay, last question, we're gonna wrap up because
Yeah.
it's okay, I guess. So just what are like favorable, like from the institutional side, or like from your perspective, what are some favorable, I guess, excuse me, like favorable default rate markets, if you will, for, let's say, for flipping projects? Like how does it work? Is it like, if you are working in a primary market of sort, you have like a 5%, let's say, default rate, then you move out to other markets, perhaps the default rate increases, and like, what is a good default rate that you guys see in terms of the markets and that operate investors?
It's hard for me to answer that, right? Because we've excuse me, we've had almost no defaults to date since we began originating. I I think we have maybe one. Sorry. So yeah, so we don't have any defaults to date. So internally, our data is absent of that. So I don't know.
But do your institutional kind of buyers provide that to you when you?
Yeah, I can tell you. Like, let's see.
No.
But it's just like markets that have gotten. I don't know if the default rates have gone up yet. Everybody's just kind of being being conservative right now. So like, I know like Austin, Texas is the one that a lot of lenders, a lot of loan buyers are being super conservative about. Like Austin experienced such an extreme boom that there's a lot of concern there now. And where else? I mean, we're not really involved in those markets. Like we didn't do much in Austin. We didn't do much in any other like market that really heated up. So I don't really have a
Tampa, let's say Tampa, perhaps. Have you guys?
We've done a bit in Tampa, and so far performance has been great for us. Okay. Yeah, the real test is the next 5 years, really. Like if you had a ton of defaults in the last 5 years, I mean, you were doing something very wrong, very hard. But yeah, the next 5 years will be pretty telling. I think that's when everybody will be tested.
Okay, so that was great. So thanks, George. It was a pleasure.
Of course. Thanks for having me. This is a great platform.
Thanks. Thank you as well. Yeah, so we'll talk more. Okay.
Yes.
I'm going to have more questions. Thank you so much. Thanks to everyone.
Thanks, George.
Thanks, guys.